Vietnamese electric vehicle company Vinfast Auto joined the stock market last month via a SPAC, and shares soared 800%, giving the company a market cap over $200 billion. Shares have quickly reversed, but the company still has a steep valuation of roughly $68 billion. That makes Vinfast Auto the third largest car company trading in the US, with only Tesla and Toyota ahead of it. But Vinfast sold only 7,400 vehicles last year, and according to the Financial Times, only 137 vehicles have been registered in the US since June. Even if Vinfast is able to hit its target of 50,000 in sales this year, that still puts it well below other car manufacturers. For comparison, Tesla delivered 1.3 million vehicles last year, and Chinese car company NIO delivered 122,000. Not surprisingly, Vinfast is also an unprofitable company. Based on figures from the company presentation, which have been converted into US dollars, Vinfast lost $2.3 billion over the last 12 months, with negative free cash flow of almost $3 billion. But $540 million of revenue means the company is valued at a staggering 130 times sales. The balance sheet isn't too good either. The company came to market with only $160 million in cash, which isn't going to last long, so further funding will likely need to come from the market or its parent company, Vin Group. But the bigger challenge is the quality of the cars. Vinfast has been criticised by EV critics for selling overpriced cars with poor quality. Indeed, Vinfast had to recall all of its SUVs in the States due to malfunctioning software. With the company building a new factory in North Carolina, there needs to be sufficient demand for the cars, but right now that's not certain given the reputation of its vehicles. So all this begs the question, why is Vinfast stock so overvalued? And there's a relatively simple answer. The amount of Vinfast shares that were floated on the Nasdaq is incredibly small. The float represents around 1% of the company, with the rest being owned by billionaire founder Pham Nhat Vuong. And such a small float means it doesn't take much to move the stock around. And because there are so few shares available, it's almost impossible to take the other side and short the stock. Even if you do find shares to short, the interest makes it incredibly expensive to do so. A similar event occurred last year when Hong Kong company AMTD surged over 20,000%, taking the company to over $300 billion in value. Back then, it didn't take long for AMTD to fall back to earth, and today the company has a market cap of just $1 billion. A similar path beckons for Vinfast Auto, since the fair value of the company appears to be a lot lower from here. So make sure you don't buy this stock, but these are my personal opinions, not financial advice, and I hold no position in this company. For better investing ideas, make sure to visit our website, overlookedalpha.com.